You hand over a lump sum, decades later you get checks. What happens to your money in between is where the machinery lives. Annuities emerged in their modern form during the late 1800s. Insurance companies needed a product that solved a specific problem. People were living longer than actuaries had predicted, and retirees were running out of savings. The solution was elegantly simple. A person would give an insurance company a large sum, say $50,000. In return, the company would promise a monthly payment for the rest of that person's life. The company kept whatever was left over. Here's what the buyer didn't know yet. The insurance company was betting against their longevity. If you died at 65, having paid in at 62, the company kept the remainder. If you lived to 95, the company paid out far more than your initial deposit. The math worked because some people died early, others lived long. The insurance company's profits sat in that gap. By the 1950s, annuities had fractured into dozens of variants. Fixed annuities guaranteed a set payment rate. Variable annuities let the buyer's payout fluctuate based on investment performance. Indexed annuities pegged returns to stock market indices. Each structure shifted the risk differently from the insurance company onto the buyer or vice versa. The products became harder to compare, harder to understand. The cost structure reveals the machinery. Annuities carry surrender charges, penalties if you withdraw early, sometimes lasting 10 or 15 years. They carry mortality and expense fees, which compensate the insurance company for longevity risk. They carry administrative fees. Some carry commissions paid to the agent who sold them, typically 5 to 10% of your principal. These fees compound. They're deducted from your balance before your payout is calculated. What you're actually buying is transfer of risk. You're paying the insurance company to absorb the possibility that you'll live a very long time. They're absorbing the cost of paying you for decades. In exchange, you get certainty, a check, predictably, for life. The insurance company profits when the actual cost of your longevity is lower than the price you paid. Today, annuities remain common but controversial. Regulators have noted that some are sold to people who don't understand them. The products are opaque, surrender charges lock buyers in, and the fee structures often favor the insurance company more than the buyer. Yet for someone seeking guaranteed lifetime income and willing to trade liquidity for certainty, the fundamental mechanism still functions as it did in 1890. You pay now. They pay you later for as long as you live. The annuity is insurance against your own longevity. It's not an investment, it's a bet between you and a company about how long you'll live. Understanding that distinction between investment returns and longevity protection is the difference between knowing what you own and discovering it too late. This video is for educational and informational purposes only and is not financial advice. Always do your own research. Subscribe to uncover the hidden mechanics buried inside the products you own. New case every week. This video is for educational and informational purposes only and is not financial advice. Always do your own research.